All right. I don't have my coffee cup. Can't start my show without my coffee cup. Good morning, everybody. Good morning and happy Friday. Today is July 21st, and I just realized I don't have my all-important cup of wake-up juice next to me for my morning show, but we're live. We must press on. I hope you guys are well this morning. Top story in the news today, American Express just reported earnings. They've reported some pretty good numbers. Spending is way up, especially spending among millennials and Gen Zers. Put a pin in that. That might be important. But overshadowing the good results from American Express was $1.2 billion set aside for credit losses. One of the biggest credit card companies in the world is starting to worry that maybe people can't pay them back. Whoops. That could be a big problem, especially as America's credit card bill approaches $1 trillion. It's another sign that people are stretched too thin. Inflation caused the cost of living to rise too fast. And, well, now people are just out of money. They're putting the cost of life on the credit card. And American Express is saying, I'm beginning to think these people can't pay us back. So they're setting aside large amounts of money to make sure that doesn't become too big of a problem. Also going on right now, big story. And, I heard this on my buddy Chris Taylor over at Financial Prepper yesterday. Yellow, it's the third largest lighter than load trucking companies in America. This is a big trucking outfit. They move less than load, means they move like a pallet. If you have a pallet of things you need to ship, it's something too big to just put on a UPS truck, but it's too small. You're not going to reserve a whole big truck to carry this. So you just take a section of a load that's going somewhere else. It's called less than load freight. Well, Yellow is the third largest LTL freight carrier in the United States. And in the last couple of days, they missed a total of $50 million in payments to their company pension fund and to their healthcare fund. And it's so bad now that, according to this article in Bloomberg this morning, Yellow drivers will lose their health insurance come Monday. Or 2 days from now. I'm sorry, that's by Sunday. They'll be out of healthcare coverage. And so, of course, the Teamsters are threatening to instantly go on strike if that happens. The problem is Yellow is a zombie company. The only reason Yellow is still in existence is because they have been able to access cheap debt. Does any of this sound familiar? Have we talked about stories like this on this channel before? Yellow has another $1.2 billion. There's that number again, $1.2 billion. Yellow has $1.2 billion in debt maturing this year. Debt that was taken out at much lower interest rates years ago. Well, now interest rates are sharply higher. So if they refinance that debt, the payments on that debt goes through the roof. But Yellow is already burning through cash because freight is down. The economy is slowing. People aren't moving as much stuff. Yellow has about $100 million left in the bank. They're burning through tens of millions of dollars every few months, and they need to refinance hundreds of millions, maybe even $1.2 billion worth of debt at a higher rate. This company is toast, and their drivers are losing pension benefits, they're losing healthcare benefits. So unless Yellow pulls off some kind of a miracle restructuring, kind of like Carvana did the other day, this company won't be around for much longer. And also, today is Friday. Today is options expiration day. And there is a lot of options expiring today. And there's also a rebalancing going on in the NASDAQ. Could make a mess of things later in the day. We'll talk about that one also. But first, it's time to shrink my big melon of a head. And let's see what's going on in the indexes. Oh, look, the Fear Greed Index is at 82. We are now, 52 days straight where the CNN Fear Greed Index has been above 70. We've been above 70 since when? Since June 5th. We went above 70 on the Fear Greed Index, and we remain there right now. Hey, you know what? Markets are overbought. I'm sure this is going to end very well for everybody involved. What do I know? I'm just nobody special. Looking over at the S&P 500, it is up 16 points this morning, or 0.36%, 4,551 for the S&P. The Dow is up 65 points, or 0.18% at 35,290. Dow is now on a 9-day winning streak. It is closed in the green 9 consecutive days. Will we see a 10th? Only time will tell. 35,290 on the Dow. The NASDAQ, which got bludgeoned yesterday, clawing back those losses today at the opening bell at 14,175. That's up 112 points, or 0.8%. So it looks like it's risk on in stocks today. Uh-oh, but wait, the dollar is looking a little bit stronger at 100.98, up another 10 basis points. The dollar got absolutely obliterated last week Big sell-off in the DXY versus other currencies, and we clawed back some of that this week. Was that a dead cat bounce? Only time will tell. Let's look at this. This is a medium-term chart of the DXY. All right, here's that bludgeoning that we got last week in the Dixie. You'll zoom in a little bit on that. So down we went. Now, I drew this blue line. This was actually a couple of weeks ago I drew this line. It came in at just over 101. And I remember thinking to myself, that's an odd place to find support at 101, especially, just one tick away from that all-important psychological level of 100. But, the chart is the chart, so I left the line there, and it looks like that's exactly where we are right now. We came up and touched it yesterday, and then right now we were above it for a couple of minutes pre-market today, but now we're heading lower again. This level was previously support. We bounced off it 1, 2, 3, 4, 5 times until we finally broke down below it last week. So we'll see if this level holds. If we hit our head here and we start heading lower, that's a very bearish sign for the dollar. That means we're heading even lower, which would put upward pressure on stocks, commodities, just about everything. Or this is a false breakdown, and we're going to fail this back test, head above it, and the dollar's going to resume higher. Keep an eye on this one, guys. This is the denominator in the price calculation. If the dollar gets weaker, number go up. If the dollar gets stronger, number go down. All other things being equal, that's how it would work. Of course, all other things are not equal. It's just something to keep in mind. Looking over at the bond market this morning, we have got a mixed bag in yields. What are we doing? Not Vietnam. There we go. We have got the long end of the curve in the red. The short end is slightly green to modestly in the red. The 30-year Treasury is down 4.5 basis points at 3.87%. The 10-year is down 4 basis points at 3.81. The 2-year flat on the day, yielding 4.83%. And the 1-month Treasury at up 7 basis points, 5.36. Now we're going to see that start to rise over the next few days, the 1-month Treasury, because the market is anticipating a 25 basis point rate hike from the Federal Reserve. That is happening next, I believe, Wednesday on the 27th, which we will be going live for Jerome Powell's press conference, by the way. So we should see the 1-month start to climb over the next few days. And looking over here at the commodity space, we got gold is down about $6 this morning, or 0.33%, trading at $1,964. Silver is down 7 cents, 0.28%. At $24.89, silver broke below $25 yesterday. Crude oil, WTI at 0.68, up 68 cents today, 76.33. Keep an eye on that one. We'll be right back to oil. Also, we got wheat down 2% this morning. Futures trading at 7.12. Looks like this story of the Black Sea crisis that's going on right now. A lot of people were expecting ships to start getting hit and sunk overnight. That didn't happen, although there's still missiles hitting the port of Odessa. But in the absence of further bad news, it looks like wheat is going to head lower. Let's look at two of those charts real quick. WTI crude oil, again, that 200-day moving average, guys. Look, that thing has been holding. I'm not saying it's going to stay below it forever. It obviously won't. But for now, 1, 2, 3 attempts to break above it have all failed. We'll see if we make another run at it right now today. Now, I got a super chat before we went live from Mr. Mike Kathman. Thank you very much, Mike Kathman. I appreciate that, sir. He says, not financial advice, of course, but pre-oil up, who would you buy? So there's a couple of ways that I trade oil, and I just want to emphasize that part about not financial advice. Guys, want to emphasize I am nobody special. My background is mechanical engineering. Always consult with your own professional. Never follow some YouTube guy into a trade. However, with my money, were I to trade oil, which I'm not trading oil just yet, I'm waiting for a confirmed breakout above the 200-day moving average before I deploy any of my own money. But when I do so, there's a couple of ways I would do that. Some of the more passive ways you could do it, or not passive, I guess, less aggressive. You could buy USO. That's the U.S. oil fund. That's an ETF that invests in oil futures. So that's a relatively safe way you could invest in that. There's also XLE, which is an ETF that invests in oil companies, not the oil futures themselves, but the oil companies. But XLE does tend to track with the price of oil. Within XLE, 50% of the holdings in that ETF are two companies you may have heard of, Chevron and ExxonMobil, tickers CVX and XOM. Those are also pretty much track the price of oil. They're both good dividend payers. If you want to be a little bit more aggressive, you could go with something like Devon Energy, ticker DVN. That's one that I own personally at the moment, although I'm not trading in and out of it. I just have shares parked in my portfolio because I like the dividend on that one. Devon Energy, though, that tends to be more volatile along with the price of oil. And another way, if you want to be more aggressive, you could go with something like an ERX, which is a levered ETF. Now, that has a lot of the same holdings as the XLE ETF, except it uses options and it's levered. Now, one note of caution with the levered ETFs, they are lousy long-term holds. That's not something that you would ever want to park in your portfolio and just leave it there, because anytime you're looking at one of those 2X, 3X levered ETFs, zoom out to like a 10-year chart and look at what those things do. It's an ugly picture because those funds are designed to lose money because they're always dealing in time contracts like options and futures. And so there's always that time decay, that contango, eating away at the fund's assets. So they are literally designed to lose money. Those are only appropriate for in and out trades, not long-term holds. So that's how I would play oil, or some of the options I would use to play oil. But again, not a financial advisor, and I am not currently trading in oil. Thank you very much, Mike. I appreciate the super chat and the support of the channel, sir, very much. Moving on, let's talk about the wheat trade also. You know, we mentioned this one yesterday with everything that was going on with the Black Sea. This is also one that I am not yet trading in because I have been waiting for the 200-day moving average to break, and, well, it didn't. Here we go. Yesterday, we broke above it, but it was a failed breakout. We came back below, and we're still trading right around that range today. So, you know, the 200-day moving average is proving to be rather stubborn here for a lot of things right now, oil and wheat among them. But let's talk about this story now, guys. This is the big one this morning. American Express profit rises, but it sets aside more money for possible defaults. I want to emphasize possible defaults. Those defaults are not happening yet. If you look at the number of defaults in consumer credit, right now we're actually below pre-pandemic levels. So there's not a lot of defaults or a lot of personal bankruptcies happening right now. They are on the rise, but they're still historically low. So it's important to keep this in context. This is a problem that is on the horizon. It's coming, but it's not here yet. And American Express sees it coming, and that's why they're setting aside this money. American Express saw its profit and revenue climb in the second quarter, and credit card use is climbing, but the company stock slipped before the market opened as it set aside more money for possible defaults on payments. Amex earned $2.17 billion, or $2.89 a share, topping expectations for $2.80 a share. A year earlier, the company earned $1.96 billion, or $2.57 a share. Total provisions for credit losses were $1.2 billion in the prior year. It was $410 million. So the money they're setting aside for credit losses has tripled in a year. This is on the rise, but again, still historically pretty low. But setting aside $1.2 billion for people not paying you back, that's nothing to sneeze at. They're citing higher net write-offs and a net reserve build of $327 million. That's compared to a net reserve build of $58 million a year ago. So a big change in their net reserve build. Shares fell nearly 4% pre-market on Friday. They're doing better than that now, though. Something I want to note here, millennial and Gen Z consumers made up more than 60% of new accounts worldwide. Their spending increased by 21% in the U.S. from a year earlier. That's kind of scary. Millennials and Gen Z spending increased 21%. So, you know, younger Americans have not made any adjustments to their standard of living to account for this huge increase in the cost of that standard of living. Was it a sense of entitlement? Is it stubbornness? Is it belief that better things are on the horizon? Forget the reason why. It's just happening. How many of these people have no intention of paying it back? We're talking about people, you know, I don't want to lump the whole generations together here, but there's no way to avoid it in this conversation. There's a large segment of this demographic that took out massive amounts of student loans with the belief that they never had to pay it back, that they shouldn't have to pay it back. They felt entitled to that money and that they just deserve it, and somebody loaned it to them on the promise they'd pay it back, and they're just never going to pay it back. Is that what's going on here with American Express? Maybe that's why American Express is setting aside $1.2 billion, because they realize most of this increase in spending on credit cards is coming from the same people who have their student loan payments coming back in just a few weeks. Keep an eye on that one. And look at this chart, guys. This is the chart of consumer credit in the United States and all revolving plans. This is America's credit card bill. And here we go. It was up here around $858 billion when the pandemic hit. People got out of debt because they couldn't spend money. All the stimmy cash was flowing. And then right around the middle of 2021, we started putting the cost of living on the credit card. And look how this number has just ballooned for the last 2 years. And now is this chart starting to roll over? Is it starting to top out? We've been here before. It does kind of look like that. American Express stock this morning down 4.83%. It was down only 2% for a minute there, and it looks like it's selling off now. So shareholders in Amex are not liking all that money getting set aside for credit losses. Check out this story, guys. This is a big one here, too. And shout out to my buddy Chris Taylor over at Financial Prepper. He was on this story pretty quick yesterday. He did a live stream talking about this. Teamsters planned 22,000 worker strike at trucking firm Yellow. And guys, this is not a case of, the union is just trying to shake down the company for more money or anything like that. This company has royally screwed their employers or their employees with mismanagement here. The union sets a July 24th walkout date after missed benefits payments. The company has attempted to combine divisions and refinance debt. The union, representing 22,000 workers at Yellow Corp, plans to strike as soon as next week after the beleaguered short-haul trucking company failed to make a $50 million payment for employee benefits. Pension accruals and health care benefits will be suspended July 23rd. That's Sunday. Imagine you work for this company, guys. Imagine you're a truck driver and you find out in 2 days your health insurance goes away because your company didn't make the payments they had to make. Imagine you have a kid with a major expensive illness or something, and you're facing financial ruin because the company you work for stopped paying for your benefits. Wouldn't you be ready to walk out? I mean, this is a big freaking deal. Pension accruals and healthcare benefits will be suspended by July 23rd if Yellow doesn't make the necessary payment, the International Brotherhood of Teamsters said Tuesday in a statement. The union said it's preparing for a strike as early as July 24th. Yellow is the third largest less-than-load carrier. They've been struggling financially as they seek to refinance more than $1 billion of debt that matures in 2024. There's that problem, guys. It's actually $1.2 billion. I saw in another article. You've got low-interest debt that they took out years ago. That debt is now coming due. They can barely afford the payments as it is, even though that debt was borrowed when interest rates were much lower. Now they have to either pay it back or refinance it. Well, this company doesn't have the money to pay it back. They only have about $100 million in cash left, and they're losing money, about several tens of millions every quarter right now. So they can't pay this debt back. They can't refinance it because the interest rates have more than doubled since they took out this debt. So the payments would go up. That would just accelerate their cash burn. And so they're backed into a corner with this debt, and they also can't make the payments for this benefits for the healthcare and the pension fund because it would burn through half of the cash that they have left. So Yellow is really painted into a corner here. I don't see a lot of options for this company. They're going to have to restructure their debt. We'll see what happens. Let's see. What do we have here? Yellow's the third largest less-than-load carrier. They have $100 billion in debt. Its stock has been in a tailspin. What else do we have? I want to show you this other thing here. Where do we go? All right, first of all, this is why Yellow is so hurt. This is the producer price index for LTL freight, less than load freight. Now, you can see, it was humming along here pretty low. The pandemic hits, and then we had the shortage and the shortages of everything. Everybody was buying stuff. The freights were all backed up. The trucking carriers were killing it. The price of LTL freight started to climb. It went from about 315 on the PPI for freight to as high as 436. So companies like Yellow took out all of this debt as the prices were going up. It was low interest debt. Well, now the prices are falling because people aren't moving stuff as much, and that debt is getting more expensive. So this is one of the reasons why Yellow is so hurting right now, because stuff just isn't moving like it used to. The price of the freight is going down, so Yellow's not making as much money even as their debt servicing costs are going up. And one thing I want to notice, I saw another article about Yellow this morning. This one is in Wall Street Journal. It's the same story, but I just want to point out one thing here, guys. It was this paragraph right here. Yellow is under pressure to repay a $700 million federal loan that was made early in the COVID pandemic. It must also pay down an outstanding loan balance of $500 million owed to a group of lenders led by Apollo Global Management. Now, I zoomed in on that because Apollo Global Management, you may recall 2 days ago on my morning live stream, I was talking about Carvana had just restructured $1.2 billion of debt. There's that number again. That's the third time I saw $1.2 billion this morning. Well, Carvana had just restructured, i.e. defaulted on $1.2 billion of their debt, and the biggest lender of that debt was Apollo Global Management. So that's 2 days in a row I've seen this company, Apollo Global Management, on the receiving end of a zombie company not able to make their debt payments. And that makes me say, I wonder what might be going on at Apollo Global Management. Well, right now, their stock, it's down a little bit, 0.36% this morning. But take a look at a longer-term trend of Apollo Global Management, and this stock is going crazy. I mean, this thing, first of all, look at this. Let me know if this looks familiar. You see, making new highs in the share price, but look at the RSI. RSI is making a lower high as the price makes a higher high. That's known as an RSI divergence, folks, and that is a sign of a reversal in a stock's trend. And, well, you got two big companies defaulting or potentially defaulting or restructuring Apollo Global Management's debt. Maybe this company isn't doing so well. Carvana makes the news. Yellow Trucking makes the news. How many smaller companies are out there defaulting on debt to companies like Apollo that aren't big enough to make the news, but all those stories in aggregate could potentially take a big hit out of a company like Apollo? Now, Apollo is a huge asset manager. They have over $500 billion in assets under management. So even if they lose a few $100 million in Yellow Trucking or in a Carvana case, it's not going to break the bank for them. But there could be hundreds, maybe even thousands of smaller stories going on behind the scenes that you don't hear about. That's something to keep in mind. That's how these zombie companies and these higher interest rates could really balloon into a big problem. And one other thing I want to talk about here, guys. Friday will be an active day on Wall Street with a major index overhaul and options expiration. And this is your wild card for today. We could see some fireworks towards the end of the day here. Let me just get into this article. Two structural shifts for Wall Street on Friday could cause, emphasis could cause a spike in stock market volatility on the final day of trading for the week. One notable event is the expiration of thousands of options contracts on stocks, indexes, and ETFs. While trading volumes have been light in July, options exposure is still strong relative to past summers, according to Goldman Sachs. We estimate that this Friday will be the largest July options expiration on record, driven by continued growth in index and ETF options volumes. So people are just YOLOing into these passive funds, and all those options are expiring today. We estimate that over $2.3 trillion of notional options exposure will expire this Friday, including $500 billion notional of single stock options. That's according to John Marshall, head of derivatives at Goldman. With options set to expire, trading volumes typically jump with investors execute the contracts to collect their profits or roll them over to the next month. The other major change is a special rebalance of the NASDAQ 100 index, which takes effect at the start of trading on Monday. A rally in the largest tech stocks this year, such as Microsoft and Nvidia, the AI stocks, that's caused concern that the stock market is too concentrated in just a handful of names. The NASDAQ 100 rebalance will dilute the impact of the largest stocks in the index. In other words, the indexes they're going to sell Microsoft and Nvidia and buy some of the other names. Now, that's important because the change could force index funds and other investment products benchmarked to the NASDAQ to adjust their holdings. For example, the Invesco QQQ Trust, ticker QQQ, which tracks the NASDAQ 100, that manages more than $200 billion in assets. So that fund is going to be selling Nvidia, selling Microsoft, and buying the other names in the index. So we could see a big drop in those names. Emphasis could. That's a big change that's coming up, and it takes effect this afternoon. And I got a couple of thank yous I have to send. Thank you very much to Lolo, who says, "You're special, Jack." Well, thank you very much, Lolo. I appreciate the kind words and the super chat, the support of the channel. Thank you very much for that. I appreciate that. And thank you to my man, Dan Hedin, who says bankruptcies have already surpassed 2022 numbers. That's a great point, Dan, and I wish I had that chart ready to rock. I should right now. Just in the first 6 months and a few days into July of 2022, the large bankruptcies in America have already surpassed all of the bankruptcies that happened in 2022. We're actually the highest level of bankruptcies in America right now seen since 2010, which was the tail end of the global financial crisis. Not a period of history we'd care to repeat. And guys, we're only in the first half of the year. So this could accelerate into the second half of the year, or it could decelerate. That's also an option. But suffice it to say, only halfway through the year, we've already passed the number of bankruptcies from last year. That is not a good sign. Meanwhile, stocks just continue to march higher. One of these things has to give, all right? And my opinion, it's going to be the stocks that are going to give. Now, economy and stock market are not one and the same. They're two different animals. But whenever the deviation between the two grows, one of them snaps back abruptly and violently, And my bet is that it will be the stock market that snaps back to the downside, not the economy that snaps back to the upside. But only time will tell. Let me know in the comments, what do you guys think is going to happen with that one? And guys, that is about all the time I got for today. I just want to say thank you very much to everybody for spending your time with us today. Thank you very much to all my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.